One of the most popular ETFs, especially for income-focused investors, over the past few years has been the JP Morgan Premium Income ETF known as JEPI. Now this is likely because JEPI has a trailing 12-month dividend yield of between 11 and 12%, which you're not really going to find in many other stocks or ETFs. JEPI also has a well-diversified portfolio, and on top of that has the potential for some capital appreciation. So what is there not to love about this ETF, with around $25 billion in assets under management? Stick around until the end of this video because we are going to do a deep dive and see if the JEPI ETF is truly worth the risk that might come along with it. Now we're going to go through all this and more. Right after you please drop a like in this video and subscribe for more content like this in the future. First, a little background on the JP Morgan Equity ETF. The ETF seeks to deliver monthly distributable income and equity market exposure with less volatility. The fund is managed by a set of portfolio managers with over 60 years of combined experience. Now, the fund not only invests in equities, but also utilizes options as a way to generate higher income by writing out-of-the-money S&P 500 call options. And because the JEPI ETF is so focused on a strategy of high income-based approach, and this is not only from dividend stocks, but also utilizing derivatives and cover calls to juice the high distribution yield, with the goal being that between the dividend payments and the premium, the shareholders should be passed along a good-sized dividend on a monthly basis. Now, JEPI is very well known for this covered call strategy. And if you didn't know, a covered call is an option contract where the option seller owns the underlying stock or ETF that they are going to sell. Selling a covered call to a third party gives the buyer the right to purchase the underlying security at an agreed upon price, which is known as the strike price, by an agreed upon date, which is known as the expiration date. Every option contract has a buyer side and a seller side. So when selling the option, you earn the premium, the buyer pays the premium. Selling a covered call means that if the underlying security price goes above the strike price by expiration, you would be required to sell the shares to the opposing side. Now, by implementing this covered call strategy, JEPI doesn't only earn a large amount of premium on an ongoing basis, but also by selling covered calls, it helps with downside protection if the market was to really turn for the worse. Now, a little bit more about JEPI. The actual price of the fund is up 6.07% since the fund's inception date, so it hasn't really grown all that much and appreciated in ETF price, although it does have the potential to do so. Now, the expense ratio for JEPI is 0.35%, which isn't all that bad for an actively managed fund. The dividend frequency is monthly, and the dividend trailing 12 month is $6.19, or around 11.3%, which again makes this fund very favorable for income-focused investors. Now, going over JEPI's holdings, you can see that the fund is well diversified, which can definitely give investors a sense of security and hopefully the potential to mitigate future risk. As you see, JEPI does invest in dividend-paying stocks as well. The top 10 holdings is the JP Morgan's U.S. Government Market Fund, Microsoft, Hershey, MasterCard, Amazon, Pepsi, Progressive, Comcast, Coca-Cola, and Visa. Now, JEPI does have around 136 holdings as of right now. So like I said earlier, the fund is well diversified. Now, talking a little bit more about JEPI's monthly distribution, because this is one of the biggest selling points of the ETF if you were to ask me. JEPI does offer a monthly paid dividend, as we said earlier, but as you see right here, the monthly paid dividend is not guaranteed to stay the same, and historically, it's done everything but that. There's some months where JEPI's paid out 54 cents per share, and this is on a single month basis. And there's been months where JEPI's paid as low as 26 cents per share. But as you can see, since the fund's inception, JEPI has paid out consistently on a monthly basis, although there's been times where the payout was less than investors would hope for. Overall, if you were to average out all the payouts put together, JEPI's probably paid out around 38 to 45 cents per month if I were to guess. Now, this is one of the things about JEPI that I don't necessarily love as a large shareholder. I currently have around $60,000 to $70,000 throughout my portfolios invested into JEPI. But with the inconsistent payouts on a monthly basis, because of the market conditions, which makes sense, it's hard to know exactly how much I should be expecting or how much any investor should be expecting, especially if they have a decent amount of money sunk into this ETF. And if we were to put JEPI up against the S&P 500 and use the metric total return, which is the share price return along with all the dividends, JEPI's only returned 2.92% year to date, where the S&P has returned 9.28%. Over the last year, JEPI's actually been beating the S&P 500 at 7.2% return, S&P 6.27% return. And over the 3-year time frame, S&P and JEPI are pretty close actually, with a 42.26% return from JEPI over the 3-year time frame, and the S&P 500 has returned 47.27%. So since JEPI is a relatively new ETF, it's going to likely take multiple more years to really see how the fund performs in a variety of market conditions. But I will say, as a JEPI shareholder, I have been overall pretty pleased with the returns that I've received from holding on to the fund for around 2 or 3 years now. So when it comes down to it, is JEPI actually worth investing into? Well, if you ask me, you really just have to know exactly what JEPI is, how it works, and what you're actually investing your money into. Far too often, investors will look at a high yield and see monthly paid dividends and get instantly attracted, especially if you are a newer dividend investor. Now, I'm definitely not trying to attack any of you. When I was newer to dividend investing, I used to sort all the lists by highest dividend to the least high dividend and try to buy into the highest paying dividends, thinking that that's the only metric I should pay attention to, and for some reason thinking that that would get me rich. But as history goes, it didn't take long until I was burned by multiple high yield dividend traps. And although I don't think personally that the JP Morgan ETF known as JEPI is a dividend trap by any means, I do think investors need to be careful in general when investing into higher yielding options. So when it comes to JEPI or any investment, make sure to dig deep and understand the investment to its full extent. With JEPI, yes, the monthly income is definitely great. We all love getting paid out on a monthly basis, especially during times when the market is not cooperating with where you want it to be. However, it's important to note that when the market turns around, and if you have a large amount of money invested into something like JEPI, you are likely going to see this investment lag due to parts of the strategy like we talked about earlier involving the covered calls and capping the total upside potential. Now, when it comes to investing into something like the JEPI ETF, which is a very high yielding ETF, the main reason why investors are drawn to it is likely because of the idea of higher income generation from the start. When investing into lower yielding assets, even assets that have the potential to grow their dividend over the long term, it's going to take the investor quite a bit of years in order to see a large amount of income start to be generated from the starting yield, because it's much lower than that you would find in something like the JEPI ETF. Now keep in mind, something like JEPI might be for individuals who rely on investment income to do things like cover their living expenses or fund their retirement. But there is going to be a downside of this likely. The total return and the capital appreciation potential might be much less than other ETFs out there. So for the investors that are more interested in generating income and a little bit less interested in generating total return or capital appreciation down the line, JEPI could be a great valid investment for you. But the biggest piece of advice I have to anyone is to ask themselves, what am I truly looking to get out of this investment? And does this investment match what I'm looking for? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.